In Malaysia, Indonesia, Japan, and Russia.
Yeah, all of the above.
All of the above.
Yeah.
Are you that powerful?
No, I think there's a great misunderstanding. I've been blamed for everything. I am basically there to make money. I cannot and do not look at the social consequences of what I do.
In 1997, a hedge fund manager named George Soros placed a massive bet against the Thai economy and walked away with $2 billion. He extracted all that wealth without building a single factory, designing a new product, or hiring a single worker. By spotting a flaw in how the country managed its money, he signed a legal, mathematical death warrant that derailed a booming economy, pushed millions into poverty, and stopped the nation's growth for an entire decade. To understand how a country gets wealthy enough to rob, look at this chart tracking the Japanese yen in 1985. The U.S. forced Japan into an agreement that abruptly doubled the yen's value, which rapidly squeezed corporate profit margins. Japanese megacorporations like Honda and Sony realized they would go bankrupt if they stayed. To survive, they moved manufacturing to developing nations with ultra-cheap labor. Thailand absorbed a massive influx of those foreign factories. Over 10 years, they transformed from an agrarian society into a booming manufacturing powerhouse, watching their stock market surge 800%. But this diagram illustrates the vulnerability they installed to protect that new wealth. To keep foreign investors happy, Thailand's central bank created a fixed exchange rate, legally guaranteeing that 25 baht would always equal exactly $1. By attempting to perfectly control the market and guarantee stability, the Thai government accidentally engineered a rigid vulnerability. The weapon used to exploit that vulnerability is a financial instrument called a forward currency contract. This diagram maps out the promise using hypothetical numbers. A foreign investor agrees to deliver 25 billion baht in 6 months in exchange for $1 billion, locked at that artificial 25-to-1 rate. Because commercial banks want to ensure they actually have those dollars to pay out in 6 months, they immediately go to the Thai central bank to buy them. The central bank is legally forced to honor its fixed-rate promise to every commercial bank that asks. As a result, its foreign reserves rapidly drain as foreign speculators place identical bets. A sovereign central bank turned itself into an ATM that foreign hedge funds could legally empty. By July 1997, the central bank had paid out so much money that its reserves dropped to just $2.8 billion. They needed $4 billion just to pay for basic oil imports. Out of options, the government broke its promise. They abandoned the fixed exchange rate, letting the open market determine the baht's value, triggering widespread panic. Within days, the currency cratered. It took 50 baht to buy a single dollar, cutting the country's purchasing power in half. Here is the visual equation of the final step. 6 months after signing the original contract, the investor goes to the open market. Because the baht is now incredibly cheap, they use just $500 million to buy the required 25 billion baht at the new 50-to-1 rate. The investor returns that pile of cheap baht to the commercial bank to fulfill the contract and collects the locked payout of $1 billion, instantly doubling their money. A few outsiders understood the mathematical breaking point, allowing them to extract wealth in a single trade. While hedge funds collected their payouts in New York, the reality on the ground in Thailand was devastating. Oil prices doubled, real estate companies went bankrupt, and poverty increased from 35% to 45% in just 1 year. You can see the halted progress physically manifested in the Sawthorne Unique Tower. It was 80% finished when the crisis hit, and today it remains abandoned. This trauma led the government to prioritize safety over growth. They began stockpiling $222 billion in foreign reserves, money sitting in a vault as an insurance policy, rather than being invested in education or new technologies. Without that investment in innovation, Thailand's high-tech exports have flatlined, while neighbors like Vietnam surged. The result is a super-aged society, where birth rates have hit a 70-year low and more than 20% of the population is over 60. The cost of the trade was the nation's momentum. A rising power traded its future growth for the security of a large savings account. This collapse leaves us with 3 core lessons. First, the free market rule. Trying to rigidly control market forces makes a financial system brittle and prone to shattering under pressure. Second, the cheap labor trap. Relying exclusively on low-cost manufacturing without investing in research and development ensures you will be replaced by a neighbor with even cheaper workers. Finally, the danger of trauma. Overcorrecting out of fear and saving all your capital prevents the exact kind of risk-taking required for true growth. True national resilience depends on the ability to remain flexible and the courage to build for the future, rather than simply hiding from financial predators.